So yeah, pretty intimate talk. It's going to be just you and me. Let's see if we can keep it relevant, interesting, conversation as much as possible. We'll take
Definitely.
a bunch of Q&A also. All right. We've got a bunch of startups in our portfolio raising, and it's clear that the times have changed. That 2002, there's various things, fears of war, fears of inflation, all of this stuff. And some startups are starting to get these answers like, well, we're looking at what's going to happen, etc. So it's a new kind of market. At the same time, we have more and more US investors coming to this market, more London, more Paris, more everybody visiting the Baltics. Mm-hmm. What do you see as the state of early stage funding right now? What does it look like to you at Sapphire?
Yeah. Well, first, thanks so much for having me today. So I'm Annalise Dragic, partner with Sapphire Ventures, based out of London. We're a global expansion stage focused firm. So we tend to invest at kind of Series B and then all the way through IPO. So more of that expansion stage into growth. So from my perspective, my day-to-day investing is not in kind of the pre-seed, seed, Series A land. I think it's true. Like 2021 in Europe was a breakout year. You saw a number of US funds setting up shop, more attention to the region, which I think was very much needed, and more capital piling in. And then I think coming into Q4 and Q1, as you were mentioning, you see a macro backdrop of what's happening with greater inflation, higher interest rates, public markets, multiples and valuations coming down, and the war in Ukraine. And I think then how you see that impacting into the private markets is first at those later stages and kind of the pre-IPO companies, right? I think we were very fortunate in the Sapphire portfolio. We had 8 public debuts, combination of IPOs or direct listings last year, and to date this year there's been 0 tech IPOs, right? Mm-hmm. And so I think what you first saw is those impacts into the very later stage, and now starting to trickle down into then the growth and then even into the early stage. And I think it's in really just the last 3 to 4 weeks, as I've been speaking to those early stage investors, where it's starting to trickle down versus maybe in my day-to-day kind of investing, these conversations have been happening for a quarter or so now already. I think then practically speaking, kind of what is then that mean for founders and investors as well, is having to make some adjustments to plans and thinking through, okay, if this is the state of the markets today and the volatility and the uncertainty, then need to make some adjustments in terms of raising in the current environment versus what it may have been like in 2021.
2 questions come to mind. One is sort of the common man question, like, okay, fine, up and down, markets move, but hey, good startups are still founded and built in these down markets.
Definitely.
What's the problem? Why, if you have a 10-year fund, why would you stop or slow down an investment? Why do you see that is? What's the hesitation?
Yeah, well, I would first say, like, for Sapphire, we're not slowing down, not hesitating, not changing our strategy. I think part of the market and that kind of uncertainty and volatility, that's true for founders, that's true for investors, wanting to understand kind of where things are going. I think it's definitely true that great companies are going to be built from all over Europe at any time. I think in probably the last 12 to 18 or 24 months, there's been a mentality, though, that growth can come at any cost. And that is different kind of from an ROI perspective and how you think about things. If you're just starting out and you're like, I need to build a product, I need to get an MVP, I need to get this in the hands of customers and get feedback and iterate, versus if you're then at like a 50 million ARR business and trying to become like a public company and thinking more about how can I scale up commercially. And so I think kind of to your point of like, can great companies be built? Absolutely. I think then the question just becomes how, and thinking through that kind of what are you putting in as the inputs to get that growth, and can you do that in a more efficient manner?
I think during COVID, everybody realized that it doesn't matter, if a U.S. investor is calling Nebraska or if they're calling Tallinn, it's the same Zoom call. So we're starting to see a lot more of the Western investors here also. They're also seeing some of the exits and the companies being built here. Is that good or bad? That we're starting to see a lot of the top level Silicon Valley investors coming here, and are you seeing that? Are you seeing deals with more US investors in Europe?
Definitely. I think in terms of the both Tallinn ecosystem and then more broadly, there's just more emphasis, more attention put on by US investors. And I think part of that is, yes, seeing some of the exits that are happening and the fact that great companies are coming out of Europe. I think for many of us that have been investing in the ecosystem for many years are not surprised by this, but I think you're starting to get that sense of like real momentum in the ecosystem. And that's why you see a lot of US funds, Sapphire included, setting up offices mostly in London, and then having teams on the ground to be able to go out and meet really ambitious entrepreneurs. Because even though, yes, with COVID, everything became Zoom calls and virtually, but I do think it's really important to be able to go and meet founders face to face and build that relationship.
Well, specifically as to that, and the earlier it is, the more the team, I think, is important also.
Definitely.
How does a US fund invest in Estonia, Latvia, Lithuania? How do you get to know those founders? How do you work with local investors?
Yeah, definitely. I think this comes to also from the founder perspective at different stages. Different investors can be a good match for you, right? If you're just starting out and you need to hire a team, I think partnering with like a local VC is amazing, and they can be a great partner for you because they have those connections, they have those networks, they can help you understand. So a lot of me sitting and investing at kind of Series B and then into the growth stage, a lot of it is like local investors. Even in Tallinn this week, right? You should meet with these guys and go have a breakfast here and a coffee, right? Yeah. And I think then that you get a complementary kind of skill set from an investor perspective on your board, right? Some local expertise in helping you build up, but then if you want to go and launch in the US market, you want to think about that commercial scaling journey, kind of having best practices, being part of a portfolio where you could have peers that are building companies in the US or globally and learn from them. I think that's a great way for kind of investors who have that global perspective and also local perspective to work well together.
So you syndicate in a lot of deals that you do with a local investor?
Normally, I would say for us, our default is to lead rounds and join the board and work very closely with
But you have co-investors usually with you.
Usually the existing investors in the business continue to invest on. And I think our mentality is to be very flexible and kind of work with the founder and the management team to kind of make the round composition what's going to be best for the business. And not just in that round, but like long term.
I mean, it's nice to have a good looking logo, famous name. Wow, we're getting attention from Silicon Valley. But what do you see as some of the culture shocks or some of the downsides or difficulties or problems that you've seen sometimes between the two worlds of a large US investor going to maybe a smaller market? Do you see any problems that can come in that relationship?
I think our approach and kind of why we set up the office started with myself and one of the founding partners of Sapphire, who has been in London for the last 10 plus years. And I think having people who understand the European ecosystem and understand kind of how business is conducted is very important, because I do think from just a US kind of fly in, fly out perspective, things can be lost. And I think then it can become more transactional and less based on relationships and wanting to understand and build that. That's maybe point one. I think point two as well of all investors have their biases, conscious or unconscious. And I think one bias, unconscious or conscious, that US investors can have is that, a CEO or a founder of a company has to look like in some way, right? Has to be a computer science major who then dropped out of Stanford and is also like amazing at sales,
So the
right?
typecast kind of a thing.
Exactly, right? And I think that one of the biggest strengths of the European ecosystem is like there's so many different role models of different types of founders, right? And I think that's one challenge that I can see and from some US peers who maybe have this kind of mental model in their mind of what a CEO has to look like, which I just don't think is true.
What is it like? I mean, I'm sure there's startup founders here. What's it like working with a top-level foreign fund, so to say? We've invested, 29 different startups now. It's easy for us. We've got people in Estonia, Latvia, Lithuania. We can provide support. You can come by my house. We can meet for coffee. It's easy. Regular calls. But what about when you are in London? What about when you are in, Silicon Valley? How do you work with a local startup whose headquarters is here and they are here most of the time?
Yeah, I think it's the same thing, right? It's being a true partner to the business, right? So if it's messages, it's calls, it's being there for the times that you need them. And then I think also we've built out a quite extensive portfolio growth team, which kind of helps in parallel to the investment team and as a board member and providing that advice. And that team works very much hand in hand tactically with our portfolio companies around different challenges and opportunities that come with scaling and execution. So that can be on talent and recruiting. And for many of our European portfolio companies who are looking to go to the US, that might be hiring a sales leader in the US or a GM for the US market. And okay, who I might not have the network there. Can you help me? And what does good look like? And what are some salary benchmarks? And what are things that I should think of? So that's one area. Another one is around go-to-market, kind of best practices as you scale that up. Can be both on more strategic topics, such as pricing, or it can be on like very tactical help of warm customer intros, helping deals get over the line. And then other areas that we help with is marketing, branding, and PR, because coming out of more of a local ecosystem, then you want to be also working to brand the company as that global champion and global winner in the space. And then finally, one other area that we help with is we have an in-house capital markets team as well. So that's working with a lot of usually our later stage companies that are looking to become a public company, and what does that process look like, and kind of hand-holding them through that.
Well, and I guess one of the benefits kind of came through in your answer of working with a large institutional VC is this backup, this extra staff, these people that you have in your offices. It's we're excited. We when we raised the fund, we finally were able to hire some people. But you guys have a significant team there to help the startups also. Can you talk a little bit about that? Who do you get engaged from your side? Is it just the partner? Is it the associates? Is it these marketing teams? Or can you talk a little bit about what it's like to do that kind of cooperation?
Yeah, definitely. I mean, it's everyone, right? I think for us, it's like
how big is your office, first of all?
We now have 9 people in London, soon to be 11, and we have about 95 people globally at Sapphire. And
those 9 in Europe, or to be 11, are working then only with European companies, or how?
European and Israeli as well, but yes.
And how many are there in that you have right now, European investments?
More than a dozen. So we have been investing in Europe from the start. Last year was record number of new investments for us, and we definitely want to add to it. But our approach really is that kind of long-term partnership, and we don't want to come in and micromanage the company in some kind of more private equity style and be like, no, you have to do this, and this is the only way. It's really when those challenges come up, right? Of okay, I'm trying to transition from more an inbound sales motion to an outbound sales motion. What does good look like there? And what's kind of some of the steps that I can take? Or I need to hire a CFO of my company, right? And could you introduce me to candidates? And again, like what should I be thinking about from salary and benchmark perspective? Or I'm trying to go to the US, like where should I set up my first hub of people, and can you help me hire and get the first customers and start that like snowball? So really it's a cross investment team, but then a lot of the help comes from that portfolio growth team that I was mentioning, which can be working one-on-one with different members of the management team. And I don't always know that, oh, you helped like close this customer. That's amazing. And I'm actually finding out in the board meeting. I think that's a win for us.
Okay. We as investors usually come in at pre-seed and seed, so our tasks and the work we do with the founders is actually quite a bit different probably than what you do. Because we come in before product market fit, and you're usually taking over after product market fit has been found, right?
Yes.
Can you describe, I'm sure there's a lot of startup CEOs listening, what's the difference? How does the working pre-product market fit and post, so pre-A, post-A, how do they differ from each other, and specifically working with the VC? You've alluded a little bit about what you're tweaking, what you're changing, where the advice is, but can you talk a little bit more about that?
Yeah, I think for me, I guess I don't have the experience of kind of working in the pre-product market fit. I think in the post-market fit, it is really about that scale-up journey, which I think is like the two biggest areas is a lot of times people and team and trying to scale that like
significant
quite quickly.
Hiring challenges there.
Yes, and org structure. What does that look like? Because when you're pre-product market fit, it's like people are wearing 17 different hats, and like during your day, it's like 5 different priorities come up, and you're just like fighting fires and just trying to get stuff done. And then as you become and get more of that kind of mature company, okay, now we actually have someone looking after customer success, and now they're building out a team, but what should that team look like? And okay, now we're building out our sales team, and how many reps should I be hiring, and like are they ramping, and do we think that they're like ramping fast enough, and should we be hiring more or slowing down? It's those type of questions that come once you've kind of like gotten that product market fit set. A lot of that becomes in the commercial scale up part of the business.
I'm sure it's a gross oversimplification, but a lot of the early stage investors talk about building the coin-operated machine, and you guys then kind of taking over and making it more efficient. That once you have a machine in place, that's sort of, okay, we put this much money into marketing, we provide this kind of product, and it seems to work, and you guys take over and now put it out to everyone all over the world. It seems like that's the kind of transition.
Yeah, I mean, when I talk to founders, I kind of try to lay it out of like, you have some technology or some idea that you've come up, right? And then the next step is kind of reaching that product market fit, and that's getting it in the hands of customers and seeing what the feedback and will people actually like pay for this. And then the next step is actually that go-to-market fit, and does my business model work? And does my kind of sales and marketing organization fit? Am I targeting the right type of customers? And then I think once that is in place, then it is a lot of course, you're going to continue to iterate on the product and build things out, but a lot of the capital that you raise is going to go into that sales and marketing engine to grow the company.
To put some kind of numbers on this, and I know this is very different, valuations are very different, US versus Europe. What is your typical ticket size that you guys do at Sapphire in Europe?
Yeah, for us, we invest out of one global fund, one global IC, and I think what we're investing in Europe versus investing in the US, there's actually not a big difference valuation difference. I think that great companies, no matter what, amazing founders building great products are going to get tippy top valuations. How that translates into check size for us is kind of on the low end, like the very low end, that can look like $20 million-ish. And then we can invest, up to like 100 million into a company. Would love to continue to follow on, love to continue that like long-term partnership.
And ideally it's what, B rounds on, or? B
rounds is usually kind of early-ish where we go, and I think that's usually the point where you have solidified that product market fit and can ingest, 30, 40, 50 million of capital to then go to new markets to expand and do that quickly.
Since you're a B round investor, how about some tips for those that are, late seed or A round? What do they need to be doing? What kind of slides should they be essentially filling out to be ready to come talk to you for B?
Yeah, I was having some conversations just like this morning, right, with founders who have kind of raised that Series A, which is like a very big milestone.
Sure.
And then it's kind of like, okay, well, I raised this milestone, and then it's like, okay, well, what's the next thing, and what should I be thinking about, right? It's like, okay, we can celebrate, and then it's like, okay, well, what's next? And so I think the biggest thing that you can do is think about, okay, like what are like those key priorities for me in the next 12 to 18 months? And as simple as kind of like mapping that out for you, for your management team, for the organization. And that could be from a revenue perspective and how fast we want to grow and kind of what threshold we want to meet. That can be from a team perspective, from hiring. That can be from branding and marketing. That can be from going into like new markets. It's the 4 to 5 things that really you feel like are going to move the needle in the business. And then thinking, okay, what are the KPIs quantitatively that I need to achieve to hit those milestones to be ready to really turn on that go-to-market engine to scale.
One of those rules of thumb, which as most isn't exactly right, but kind of gives you an idea, has been traditionally, now it's changing, but traditionally sort of the 100K MRR, they said, okay, if you can get to 100K MRR, you're probably going to be able to raise an A, of some kind of an A. Big, large, whatever, depends. Is there a number or measurement for B? Is it a million MRR? Is there an indicator of that you're maybe getting to B?
Yeah, I think right now also this whole concept of like funding labels and what is even a seed or a Series A or a Series B is totally, you have a seed of 20 million over here. So I think the letters are maybe a little bit misleading. I think for us, where we tend to get involved with companies is kind of when they've hit like a 5 to 10 million-ish ARR. ARR. Okay. And I think we don't have like a black and white threshold, and not all companies, it's just the top line. It could also be other metrics that show good usage or engagement. But I think that's the general kind of level.
What about by B, not all things can always keep growing. Paul Graham's got an idea, 5 to 10% a week should be growing during Y Combinator. Other people say, pre-seed, seed, maybe 20, 30% a month.
Yep.
What kind of growth numbers, sort of month-on-month growth numbers are you seeing? Because it's bound to slow down. I mean, it's easy to double, small numbers, but big numbers is...
Exactly. I think that's also one of the transitions, right? I think from looking at the business on a month-to-month basis to a quarter, quarter by quarter basis to on a year, right? And I think when you get to the Series B stage, a lot of the metrics that you're tracking of what does this look like year over year. Of course, like you're looking at this as a weekly basis when you're seeing, okay, like what's up, what's down, how's the business doing? But when you're reporting back to your investors and your board, a lot of it is shifting kind of from an MRR mindset to then an ARR mindset, right? I think for us, it is that kind of like fast growth, which is like at least doubling year over year. Then I think it becomes also, okay, what does that look like from the inputs that you're putting into the business, right? Because you can put as much as you want, but that doesn't necessarily mean like that's setting up you for success in the future to have kind of efficient, scalable growth.
And the follow-up question to that, I think what's different about where, again, because you're doing B, because you're doing these growth rounds, it isn't anymore just even ARR, right? Now you're starting to also look at the unit economics, profitability, because the closer you get to IPO, you need to, show that this could be a profit business as well. Well, in pre-seed, everybody's like, fuck it, whatever, let's just see if people want to do it at all, right?
Exactly.
And then later we'll deal with every little nickel and how to squeeze the most out of it. But on your stage, you're already starting to look a little bit at profitability too, right? I mean, that's...
Unit economics, right?
It's an issue, right? Can you open up a little bit what you look for there? How efficient does the company... Is it LTV to CAC? Or what are the indicators for that?
Yeah, and I think this goes back to like when you hit that Series A mark, right? And you're looking into the Series B and what are some of the metrics that you should be thinking about and tracking. And I think one of them is looking at what's your sales efficiency. And that's kind of how many dollars you're putting into the sales and marketing engine. And then what does that look like from a net new ARR perspective? So how many dollars are you getting back? And also from a margin perspective. And then how does that look like if I'm putting in, X into my sales and marketing engine and I'm getting out Y in terms of net new ARR and I'm getting, a high gross margin, that can then is a good foundation and that can then lead to, okay, I can understand as an investor then how in the future you'll be able to grow because you're putting more dollars into that engine and able to get a good return on those dollars from an ARR revenue perspective into the business. And that can lead then on a good path to then one day becoming a public company where you are ultimately going to be valued on your free cash flow.
Absolutely. Okay, cool. We have a few minutes still. Be happy to take questions from the audience. And we have a traveling mic somewhere around there. Here's at least one. One guy right up front. Blue shirt.
It's coming. It's coming.
Coming by regular post, so it's going to be...
Hi, Taras from Kilo Health. I wanted to ask, what's the outlook in your eyes for late-stage startups in terms of fundraising and basically the outlook of the funds looking at the startups in late stage in the coming quarters, like this summer, this autumn, this winter, and as well for early-stage startups the same way? As much as you have thoughts for this, is winter coming for them too?
Yeah, I think one of the things from the later stage startup world is many companies, including our portfolio, raised a lot of capital last year. I sit on the board of one of our companies, Matillion, and they did 2 rounds in the last 18 months. So I think companies that are in that later stage that have raised a significant amount of capital don't necessarily need to raise additional funding right now. And I think are also trying to understand, okay, what is the funding environment going to look like in 6 to 9 months? Being a later stage company versus an early stage company, that's a benefit, right, of having a larger balance sheet and war chest to some degree that you can kind of wait that out. Versus in the early stage, it is a lot about tracking what is the cash runway and what does that look like. And you may have less flexibility on if I can raise today or if I can wait in 6 to 9 months. I think it's hard for me or kind of anyone without a crystal ball to be able to tell, okay, are things going to get worse or better? But I think the prudent kind of planning to do is to to kind of plan for scenarios in which it's harder to raise capital and it's going to be more expensive.
Like more from the market perspective, what to expect in a way. Let's say as the as the cycle sort of trickles down from public markets to crossover funds to late stage, will it trickle down to the early stage companies before the market turns around? I think that's like ultimate question from the early stage guys.
Yeah, and again, that's not my day to day, so maybe you have a better perspective. But at least what I'm hearing is that's starting to happen even at the early stages.
There's definitely a slowdown. There's going to be people who are going to want to sort of rechart where things are over the summer because of war, because of inflation, because of COVID in China. The ports are closed, hardware can't be built. There's all kinds of issues in the air, but my perspective is personally, just personal opinion, my perspective is that the funds as institutions have many gone to what's your investment period, 3-4 years?
Or longer. Yeah.
Okay. A lot of the early stage investors are with 3-year investment periods, okay? So it's in their LPA. They have a written commitment. They have to make all their investments in 3 years. Well, they only get paid also their management fees and everything else if they invest the money. If you don't call and you don't invest, you don't get the management fees. What do you think are the chances that these funds will be like, you know what, it's tough times, we've decided not to be VCs anymore? Obviously, they'll invest the money, right? And then it's a question of, well, how much can we wait? If it's a 3-year investment period and we wait for a year, that's 1/3 of the entire investment period. So we're going to have to do like a deal a week next year. You see what I'm saying? There will be a time that people will be cautious, but then regardless of what happens on the market, if these funds want to stay funds and if they want to have management fees and jobs, they'll have to start investing. Right? Even if they ask for an extra year to be tacked on to an investment period or something, 6 months, maybe they can take off, 9 months at the most, but then it doesn't matter what the economy is. If they want to be a fund, their job is to invest. Without investments, they're not a fund. So that's my perspective. Yes, it will slow down. Yes, people will be more cautious. Definitely any startup that has revenues, that is able to show some metrics, is able to show that they have a real product that they can monetize is going to be preferred. Cash will be king. With all of that will be positive. But no matter what happens, these funds have been raised and these hundreds of millions in commitments are sitting there. They're going to get called at some point. It's unlikely that, well, that's it. We're not doing business anymore.
Thanks. That's a great comment.
Maybe I'm wrong, but I'm thinking that's how it's going to work out. We had one more question for sure here. Yeah.
Hi, my name is Fish from Fermas. So I have a question. Have you ever invested in music streaming? And if not, why?
Well, first of all, this guy has a music startup, so I'm going to warn you ahead of time already. Look at his pants.
Just a random question.
Just by the pants, you can already tell.
I love your pants. So I don't believe Sapphire has, and our focus is also mostly in the B2B world from software perspective, so infrastructure, application layer, fintech. Definitely, if there's B2B opportunities within music streaming, something I haven't explored yet, but more than happy to learn.
Yes. Thank you. Beautiful.
Thanks a lot. My name is Richard. We see in the Nordics that a lot of institutions like banks actually put a lot of money into VCs that go for impact solutions. And it comes more, and they say, some of them like SEB say it's less risk than have your clients' money into stock or bonds or other assets. How do you see that in your part of the world?
I guess I don't really see that much, or have kind of conversations more on the asset management side. I think what I see in more of the later stage is like from the crossover funds who have some big exposure into public equities versus then the more venture side and trying to balance kind of from a risk portfolio there. But sorry, I probably don't have a very good answer from more of a banking and an impact perspective.
We are definitely not an impact fund, so we don't get any extra points from LPs for this much carbon saved or anything like that. Yet at the same time, purely on economic reasons, we've made 4 investments that are related specifically to the environment. It's one's the carbon credits, one has to do with wind energy, one with alternative meat, but one with the timber industry. All of them are investments on their own merits. We believe that all of them will be enterprise software, will be B2B, will have the capacity to make money and make money at venture scale. In that sense, I see that investing in environmental projects is a totally legitimate investment, even without any impact or special label or, I don't know, extra metal or anything. You can make good money investing in the environment. As these trends, ESG reporting and all these things are changing, I think this side of the industry is getting stronger for sure. But if you're asking whether VC as an asset is safe, well, it's safer than crypto, I think. But the reality of our business, though, less for you guys because you come in after product market fit, you don't have the failures for early stage. We have to count on probably 50% write-offs. Because if we're looking at a company in pre-seed, a million things can go wrong and will go wrong along the way. They make it to B and beyond. But in B, they're going to survive probably. It's just a question of how much are they worth. So yeah, that's the difference also, that if you want a safe VC investment, you go with growth. It's almost like a private equity type investment. But we're still very, very risky because we're investing at a very early stage, like pre-seed. And so many will fail from pre-seed to on their journey. Did that answer your question? Okay. You said last.
We are out of time.
I wish I could be more charitable, but we're out of time. So
outside of the whole, ask all the questions you want. Just catch Yrjö and Annalise.
Thank you very much for joining.
Yes, thank you.
Looks like they have some wooden sticks for us.
Yes, wooden sticks, actually sustainable straws.
Great.
Because we believe in sustainability.
Thank you.
Thank you so much.
Thank
it was
you.
so insightful.
Thank you.
Thank you.
Thank you very much.
Okay.